Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to net credit position. Get ready. It's time to take your chance with Corporate Finance. Here we are in Excel. We have our information on the left-hand side. We're going to use that to work through our practice problem in the blue area in the worksheet on the right-hand side. We're going to get down to the net credit position calculation, which is basically going to be the difference of the credits that we are providing and we have been provided. In other words, the difference between the accounts receivable and accounts payable. The credit that we are providing, meaning the credit that we are giving to the customers as we make sales on account, increasing the accounts receivable, and the credit that we are provided as we purchase on account and are getting credits to pay at a future point, that being the accounts payable. Now we're going to figure that accounts payable and accounts receivable calculations with the use of the average collection period and average payment period calculations. So to do that, let's see what we have here. We got the average daily credit purchases normally paid in a day. That's going to be our average payment period, which is going to be 25. And then we have the average daily credit purchases amount, which is going to be the 10,000. Then we have the average daily credit sales. So these are the sales we make typically on credit. And then we have the collection on account average collection period in days. That's going to be our average collection period. So what is the credit position? So we'll figure out the credit position there. And then we're going to say, well, what if the company adjusts its average payment period to 37 rather than the 25? And what's that going to have an effect, or what would the effect be in our net credit position? So what we want to do then is find the average receivables and the accounts payable. Now remember, these two amounts are amounts that are on the financial statements. So we could think of a formula to figure those amounts, but you're not going to be able to look up a formula to calculate the receivables or payables. What you typically will find are formulas in order to use the financial statement accounts to find ratio formulas for help you for analysis. So now we want to think about, well, what are those formulas that we can use to help kind of back into the average receivables instead of trying to memorize a formula to get to them. And the calculations we will have are the average collection period and the average payment period, which are given by the 30 for the average payment for the average collection period and the 25 for the average payment period. So let's think about the receivables first. So if we're going to think about the receivables, because we've seen that many more times in the past, we're not going to look at the average daily credit sales of the 12,000. That's something that would typically be on the income statement, or at least total sales would be on the income statement. We're going to be thinking about, I would first think about this calculation, the calculation of the average collection period, and then back into what I need to know, which is the average, which is the accounts receivable. So normally the calculation here would be accounts receivable divided by the average daily sales. So let's write that out, and then we can look for the unknown and solve for the unknown. So typically the average collection period would be the accounts receivable, and I'm going to put this in the outer column, and this is going to be our unknown. So I'm going to make that yellow. This is going to be the unknown, and then we have the average daily sales, brackets. Now normally we would do a sub-calculation, and we would take the normal credit sales, the sales on the income statement if they were all credit sales, or the portion of the sales that are credit sales, sales on account, sales that are going to go through accounts payable, and then we're going to divide that by the days in a year. That would be our normal calculation to give us the average, the average daily sales. Now here, they gave us the average daily sales, so we know what the in number is. They said the average daily sales was 12,000. So 12,000 there. We have that in number. We don't have to do the sub-calculation. However, if we wanted to back into what the total sales were, we can do that here just to fill out our table. So we can go Home tab, Alignment, increase the indenting. I'm going to increase the indenting here. Home tab, Alignment, increase the indenting. We know the days in a year are going to be equal to 12. I'm going to say times 30. Nice even 30 days. So we're going to say 360. And then I can use this to back into the unknown. I'm going to make this yellow, the unknown here, right? We can get to the credit sales if we needed to in this information. We don't need to here, but just so you know, we could back into, of course, the credit sales in a similar fashion. How? We would say, well, X divided by 360 equals 12,000, and then solve for x. So the solving for x would then be equal to the 360 times the 12,000, and that would give us the 4,320,000 credit sales. We can then double check it and say, if I was to do this calculation, the 4,320,000 divided by the 360 would give us once again that 12,000. And then we can calculate the average collection period, which we already, this is what we know, which is the 30 down here. This is what we would normally calculate, but now we know it. The 30, I'm going to put an underline here, home tab, font group, underline. Now we can solve for the unknown, the receivable, which we can write out algebraically now. X divided by 12,000 equals 30. And then if we were to calculate that, doing the algebra, it would be 12,000 times 30. And then if I want to double check that down here and see if I can recalculate the 30, it would be 360,000 divided by the 12,000, giving us the 30. Now, the way you might see this, if you were seeing this in just like a book problem or someone was giving you, they would give you a calculation for accounts receivable. Once again, making you think you have to know another calculation. You don't. It's basically just working the algebra over here. And that would be something like this. We'd just say the average daily credit sales is going to be the 12,000, which they just gave to us. So I'm not going to do this recalculation here. If they gave us yearly credit sales, we would have to do this again. But they gave us just the daily sales. And then we're going to take the average collection period, which is going to be equal to the 30. The 30, let's underline that. I'm going to say home tab, font group, and underline. And this is going to be then I'm just going to call it accounts receivable, or average accounts receivable, which is going to be equal to the 12,000 times the 30. So that's just another way to get to that same number here. So once we have that, next we can think about the payable side, same kind of thing, but something that we haven't done quite as often. So if we have the average daily credit purchases amount, which isn't something that we as easily can find on the financial statements, but we'd have to pick up the average daily credit purchases that we make, then we could do a similar type of calculation. And once again, I wouldn't use this number. We'd use the calculation basically for the average payment period, which is going to be similar to the average collection period. So I'd say instead of thinking about a formula for accounts payable, we're going to think about a formula for the average payment period, because that's normally the formula that we might calculate on the financial statements. So that would be something like, we'd start off with accounts receivable divided by the average daily credit purchases. So I'm going to say, all right, accounts payable divided by the average daily credit purchases. This is the unknown again, so same kind of format. We don't know this. And then I'm going to say we would normally calculate then the average daily credit purchases. They gave us this number here, the daily, but oftentimes they might give us the yearly purchases, and we'd have to figure the daily purchases, which would then be the credit payments, or the credit, let's just call it credit purchases, and then the days in a year. So we don't know the credit purchases. I'll make that yellow. We don't know the total because they gave us the average daily credit purchases. The days in a year are going to be 12 times 30 once again, estimated in a nice even 360. And that would give us the average daily credit purchases, which we actually know. I'm going to put this in the outer column. They gave us the daily, not the yearly. So that actually equals the 10,000. I'm going to indent these, selecting these three. Home tab, alignment, increase the indenting, then select this item. Home tab, alignment, increase the indenting. I'm going to underline the 360. Home tab, font group, underline. Then we can use this to back into this number if we needed to. We don't really need to here, but we could do so. So let's just do it. It would be X divided by 360 equals 10,000. Or in other words, it's going to be, if we solve for that equation, 360 times the 10,000. We could double check that over here by recalculating the 10,000 as the 3,600,000 divided by the 360 gives us the 10,000. and then we can calculate or pick up the average payment period, the thing we normally calculate, but now we know that's going to be our 25, so it's going to be equal to the 25 up top. I'm going to put the underline here under the 10,000, home tab, font group, and underline. Now we can solve for accounts payable, which would be the formula of X divided by 10,000 equals 25, which we can then calculate as 10,000 times 25. So that's 250,000. If I was to double check that number to see if we get back to the 25, we're going to say the 250,000 divided by the 10,000 gets us back to that 25 once again. If you were to see it in like a book problem or something like that, or break this down as easily as possible, as if you needed to memorize a formula for accounts payable, it would look something like this. We would take the average daily credit. Let's say, let's do it this way. I'm just going to say this equals the average daily credit, which is going to be the 10,000, and then we'd have the average payment period, which is going to be equal to the 25, or we can pick it up over here in the data set. Let's do that. And then we'll underline it and go to the home tab, font group, and underline, and that's going to be our accounts payable, or average accounts payable, which will be then equal to the 10,000 times 25. This seems a lot shorter because we didn't do this calculation breaking out the average daily credit sales because they gave us that. If they didn't give us that, we would have to break out this calculation. In other words, if they gave us the yearly credit sales instead of the daily, we would have to then pick up the daily credit sales. All right, so knowing that, then now we could simply take a look at our difference between the average daily credit purchases and the accounts payable, the difference between the average receivables and average payables. So we've got the accounts receivable, and this really should be average accounts receivable is going to be equal to what we came to up top, the 360, and then the average payable. Let's say accounts payable is going to be equal to the 250. Let's underline that and go to the home tab, font group, and underline. That's going to give us the net credit position, which is going to be equal to the receivables minus the payables. Now you can see that the net here is basically that we're giving more credit to on account than we're receiving from on the payable side. So we're basically making more sales on account, basically giving more credit as we do so, than on average than on the receivable side. So we might want to close this gap down. We could think, okay, could we can compare this to industry standards possibly and say, okay, could we limit this in some way, shape, or form? How could we do so? Well, we could collect on our receivables faster, or we could we can wait longer to pay off on our payables and extend the credit on that side of things. So let's say, what if the company adjusts its average payable period to be 37 as opposed to what did we have before, the 25? So in this case, we're going to say we're going to try to wait longer to pay off the payables. And that'll basically mean from our cash management side, we'll be holding on to the money longer. And when we look at the difference between our credit policies and us extending credit on the receivable side of things when we make sales, and us getting credit when we purchase things on account, this will shorten this difference up a bit. So we're going to say, all right, well, how can we do that? Let's do the same calculation down here that we did for this 25. But now we're going to be doing it with 37. We're going to assume that the company can adjust the average payment period to 37 from the 25. So I'm going to pick up the same information. I'm going to say this is going to be equal to this number. I'm going to autofill that all the way down. I'm going to select the autofill handle and just select that all the way down. Then I'm going to use the format painter to select this entire thing, and then go to the home tab, clipboard, and format paint. And then I'll just select this top cell so we can format paint it all in place. So once again, we don't know what the payable is yet. We do know that the days in a year are going to be equal to the 12 times 30. And we know that this number is still the average daily credit purchases has not changed. It's the 10 10,000, we can back into this number just as we did before, which would be X divided by 360 equals 10,000, or 360 times 10,000 gives us the 3,600,000. If I double check that, we can take the 3,600,000 divided by the 360 gives us the 10,000, and then we can know the total now. The average payment period is going to be equal to the 37 as opposed to the 25, allowing us to back into the accounts payable, which would be X divided by 10,000 equals 37, solving for that equation, which would be the 10,000 times the 37. That would give us the 370 as opposed to the 250. We could double check that to recalculate the 37 to see if that is indeed correct. So the 370,000 divided by the 10,000 would be then once again that 37. If we saw this calculation a little bit more as if we were just going to calculate for the accounts payable here, same thing we did up top. We can do the same calculation. It's going to be this, and this, and we're going to be picking up then the 10,000 again. So same 10,000 up top, but now we have the 37. The 37, and I will underline under the 37, home tab, font group, and underline, and then we'll pick up this being equal to the 10,000 times the 37, which would give us that 370,000 for the accounts payable. Now, if we were to think of our net credit position again, now we're going to say, all right, our average accounts receivable has not changed. It's still the 360,000, but now our average payables are equal to the 370,000. So now if we take the 360 minus the 370, we're kind of in a better position. This would be our net credit position because we're receiving more credit than we are extending, which is typically going to be, a benefit. So that adjustment allowed us to basically receive more credit than we gave. So note there's a couple ways that obviously you can manipulate or think about this. You can try to collect on your receivables faster. It's the same kind of process for our cash management process. We're going to always try to collect on the receivables faster if we can, which means we got less average accounts receivable out there, extending less credit on average out there, or we can try to pay off we can try to hold on to our money longer, paying off our payables at a later point, which will increase the credit that is given to us on the payable side, which you might think is bad. Why would I want to I want to pay off the credit soon. But if there's no charge on the credit, if we're not getting charged interest to hold on to the money longer, then any longer period we can hold on to the money and consume it, use it in a way to get a return. If it doesn't cost us anything, then we try to do that on the payable side, and those are the two ways that we can affect this, basically the net credit position. We can also think, of course, about how much our sales are and how much our payables are, but obviously we always want the sales on credit or not. We always want the sales to be increasing, so we can adjust the amount of sales that we make for cash versus credit sales and increase or decrease sales in total, as well as the payments in total. But we may not have as much control over that, considering we're always just trying to increase the sales, and the payment might be what it is. We're kind of focusing in on how fast we can collect on these items oftentimes.